is currently locked in a critical test, maintaining ground above the psychological $4,200 level. This high price point is not merely a number. It is a battleground where the conviction of buyers is tested against stiff overhead resistance. The bulls have aggressively pushed the price here based on the overwhelming certainty of a Federal Reserve rate cut next week. Yet immediate technical resistance is fierce, specifically ranging from $4,250 to $4,260. The prevailing question for sophisticated investors and commodity traders is not if the Fed will move, but whether the anticipated policy change has already been fully discounted by the market, potentially setting the stage for a buy the rumor, sell the fact reversal. The core driver behind gold's impressive sustained valuation at these high levels is the inverse relationship between the metal and the real yield on U.S. Treasuries. Real yield represents the inflation-adjusted return on fixed income assets. A Federal Reserve rate cut directly lowers nominal yields. When this is coupled with persistent global growth fears, geopolitical uncertainty, and inflationary concerns, gold naturally thrives as a highly liquid safe haven asset, driving down real yields and increasing gold's attractiveness. The implied probability of a December rate cut, derived from Fed futures data, saw a dramatic shift in market consensus, skyrocketing from approximately 30% to around 80% in a very short period. This rapid repricing of certainty and monetary easing structurally explains the aggressive, fundamentally justified move that carried XAUUSD up to the current $4,200 consolidation zone. The current price action must be viewed within the context of the preceding move, which was characterized by a bullish breakout from an ascending triangle pattern. Since achieving this higher level, the price has consolidated into a symmetrical triangle pattern, ranging between $4,160 and $4,260. This specific pattern confirms short-term market indecision as traders await external catalysts. Analyzing the technical indicators reveals contradictory signals. The long-term trend remains secured, with the price trading comfortably above the 50-day and 100-day simple moving averages, SMA. However, key momentum oscillators are flashing cautionary warnings. The Relative Strength Index, RSI, is showing negative signals after recently reaching overbought levels. And critically, the Average Directional Index, ADX, is hovering near 20, which explicitly signals weak trend strength, reinforcing the expectation that gold will continue to consolidate until the policy decision. Two key economic releases have shaped expectations for the upcoming FOMC meeting. The Core PCE price index is paramount, as it serves as the Federal Reserve's preferred inflation gauge. Recent PCE data showed the index rising 2.8% year over year, broadly meeting expectations, thereby reinforcing the central bank's belief that it has scope to ease policy. This aligns with other softer economic indicators. Data such as a steep drop in ADP jobs and mixed ISM services PMI details also contribute to the overwhelming expectations of a Fed rate cut. Furthermore, while the Michigan Consumer Confidence Index saw a slight rebound, it remains historically pessimistic, supporting the fundamental necessity for the Fed to adopt a dovish stance. For traders, the current consolidation dictates a clear strategy based on technical triggers. A confirmed close above the $4,260 resistance is necessary to initiate the next bullish leg of the uptrend. Conversely, a failure to hold the immediate support zone of $4,150 will target the strong dynamic support provided by the 50-day SMA, which currently converges around $4,067. Gold remains a highly attractive, stable refuge in a world clouded by financial and political turbulence. However, investors must wait for the Federal Reserve's communication, specifically Chair Powell's forward guidance, to confirm the immediate direction and structural trajectory for the remainder of the year.